those interest rates they all have fees associated with them. Mm-hmm. And you could be a 730 FICO, well-qualified buyer, and your rate is going to be, because of these LLPAs, is going to range anywhere between 0.5% to a full % higher than what is typically being advertised. Mm-hmm. So it actually is a big
Welcome
deal.
to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Broch Lassig, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
Hey there, and welcome back to another episode of Loans Elevated Podcast. I'm here with Ryan, and today we are talking about the mystery of mortgage rates. And this is something that is significant. We deal with on a daily basis. I know consumers thinking about buying real estate at any time certainly deal with this. I mean, here locally, we've got billboards all up and down I-15 that are showing mortgage rates, different mortgage rates on them. You can Google mortgage rates. It will show mortgage rates. You can get, there's different, what is it? Mortgage News Daily or something will publish mortgage
different
rates.
There. Yeah.
Different numbers.
And they're all different numbers.
Yeah. And then you might call a mortgage lender and you're going to get very broad discrepancies in what the quotes you get. And there is a reason for this. It's not just because one mortgage company has higher rates than the other. The fact is, almost every mortgage company has the same rates and fees. We're a highly regulated industry, and it's just not like these discrepancies aren't real. It's just the way the data is presented. So we wanted to talk about that. Ryan, why don't we dive in? There's one topic, which is LLPAs, and that's it's insane. This is something that doesn't have to do with the advertising, but the rate you actually get. I mean, there's some strategy here, but it's also kind of like,
definitely,
it's insane, the ripoff that can be.
Yeah, for sure. And it is complex. I mean, looking at the entire matrix right now, it's confusing because what they had discussed back in 2023, if we can all remember, they basically said the more qualified buyers were going to be paying a tax for the less qualified buyers to get cheaper cost. And that's essentially what has unfolded and is still into place today. So
before you dive in, let me just explain. LLPA is loan level pricing adjustment. Mm-hmm. What this is it's an adjustment to the rate. In other words, it's like a rate. Yeah, exactly. Yeah. It's like points being charged on the back end of the rate. That's what causes rates to change based on credit score, down payment, investment property versus primary home versus second home. So it's
in turn,
risk
it's more
factors.
Pay to play, or you have to take the rate higher to get your par rate. Yep. So now you're way out of range of what the normal rate is that day. Yep. So par rate essentially is the rate that has no cost associated with it. There are going to be rates.
No points associated.
No points, no upfront money required to buy down that interest rate. So the normal buy downs you're going to see, or I guess to talk about the other, I guess the counter to a par rate are your buy down points. So to give you the difference there, if you're buying down a point in rate, you're typically saving anywhere between 0.25% to 0.5% on the actual note rate.
Probably about a half.
So a par rate doesn't have any of those buy down points associated with it. Now, with that said, let's dive into the matrix itself and go over some of the complexities here and why it's important to work with a lender who understands these, because you can save yourself a ton of money. So credit scores ranging between, and this is for a purchase, mind you, credits ranging between 720 to 739. We are seeing, let's see, and it depends on the amount down. This is where it can get confusing. And it also is a testament to us always encouraging our clients to not put so much money down, because believe it or not, it actually makes these rates more expensive the more money you put down. So 720, 739 FICO score. If you put 15% down, you are looking at 1.25% in additional buy down costs to get whatever that average rate is that day, which in turn just pushes your rate up if you're going to, strive or aim to get a par rate.
So in other words, what that is if, let's just say the par rate, just for sheer sake of example, let's just say the par rate was 6%. Yeah. If the par rate was 6%, for a perfect borrower, perfect credit, perfect down payment, so on and so forth. In other words, no loan level price adjustments. And you were this person buying a home with a 725 credit score with 15% down, you would be paying 1.25 points to get that same 6% rate that somebody else wouldn't have to pay those points for. So these are risk pricing adjustments that are there, but
which is pretty significant.
It's huge. I mean, on a $500,000 property, that is like $6,250, which is a lot. Now, the thing that Ryan was alluding to earlier, which is nuts, is on that same credit score, 720 to 739, if you do 5% down, if you do 3% down, which is the best actually, you're only paying 0.75 loan level price adjustment. So you literally save on a $500,000 property, you literally save $2,500 in fees by putting less money down, or a half a point in fees by putting less money down, which is crazy because that seems like it's counterintuitive. That would be more risky if you borrow more money, but these loan level price adjustments are a bit out of whack. And it's like, we called it socialism in mortgages, because it's like for people that are more well qualified putting more money down, they're actually paying a higher expense than those people that are less qualified.
They're subsidizing the cost.
Exactly. Kind of crazy.
Yeah.
But this is also very important as you consider refinancing, because these loan level price adjustments for refinances can be even more extreme than a purchase, because refinances, the Fannie Mae, the agencies understood that refinance boom would come again. And refinances are essentially subsidizing the cost or the savings for people buying homes as well. So there's more extreme costs for refis too.
Yeah, and to dive into the significance of it as well, as you're out driving on the freeways and you're Googling online, you're seeing these interest rates that are posted, which we'll get into the averages and how a lot of these companies come up with them. But most of the time, those interest rates they all have fees associated with them. And you could be a 730 FICO, well-qualified buyer, and your rate is going to be, because of these LLPAs, is going to range anywhere between 0.5% to a full % higher than what is typically being advertised. So it actually is a big deal. I mean, think of yourself as a consumer. You go to apply for a mortgage. You're 730 FICO. You're pretty good FICO, right? I mean, that's in the good range. And they're telling you your interest rate quote is 0.5% or a full % higher than what's being posted upon billboards or what you're finding on Google. That is the reason why. It's not the mortgage lender ripping you off.
Right.
These are all coming from the government themselves. These government agencies, Fannie Mae, Freddie Mac.
And the big thing to underscore there is, like, mortgage lenders, by and large, have the same rates. The rates all come from the same darn place. There's certain things, like if you have a larger selection of jumbo financing, for example, there can be a very significant discrepancy on those rates. But when you're talking FHA, conventional, VA, USDA, regular, traditional type financing, they're all about the same. So you kind of talked about this, but the average rates, what you'll find if, Mortgage News Daily is a great one. Freddie Mac publishes this data every week. They publish this. Well, a couple things about these average mortgage rates. And Freddie Mac's data is the one that you'll hear commonly published in the big media outlets. And they'll say, mortgage rates have fallen or mortgage rates have risen or whatever. I mean, they always blow up something in the news
It'll
on
show
this.
the amount that it decreased over the last.
Yeah, and generally it's not as significant as the headline makes it seem, but they're at least a week delayed. The average rates are like a week in the past. And with mortgage rates, I mean, they're literally moving in the middle of the day. So a week's old data is virtually worthless when it comes to mortgage rates, especially in this market. But additionally, these are the average rates. So this is the average rates that the buyers get, not accounting for these points you're paying for, which is important. So like the rate itself is only a sliver of the full equation on the decisions that you should make. So you also have to be cautious. The average is, somebody could have been buying rates down, or, the general market could be buying rates down more often. It's based on people doing a ton of money down and people doing less money down. So it's not a good barometer. It's a good trend tracker, but not a good barometer.
Well, that's the thing. It's literally
rates.
all the loans that were purchased by Freddie Mac within that time frame. And who knows, maybe there was a large pool of those buyers who had to buy down the interest rate a couple points to qualify, or maybe they're working with a lender who's encouraging them, which we obviously wouldn't, but encouraging them to buy down permanently thousands in fees. Well, now they've taken all of those rates and they've given you the average. So people who are paying thousands for these lower rates have now been accounted for in the equation, and that's why you'll see large discrepancies in those average rates that are
And one thing that I've noticed just from an industry standpoint, we've talked to people in closed-door meetings that are not public meetings, colleagues in the industry that are, or maybe competitors in the industry, we've talked to them. They're literally charging borrowers, they're quoting rates with significant buy-down points or points just in general on purpose for a couple of reasons. There's risk if a person pays off a mortgage that they can get penalized, but if you charge a lot of points up front, that penalty goes away. So they do it for that reason, but they also do it for the reason that talking about lower rates and almost sidestepping the discussion of the fees attached to those lower rates is a much easier conversation for somebody in our position than it is to talk about a rate that is higher than everybody's seeing advertised. So tons of lenders are doing that. And so when we talk about these average rates, we know for sure this is happening where the average rate is driving down. But what I wish they would publish is average rate and average fees, because then it would provide a lot more clarity. But we know as an industry, the fees are up, the rates are down. Lots of lenders are promoting paying a lot of points, and we don't recommend that. And I'll explain to you why. I'm just going to give you an example real quick. Let's say it's a $500,000 mortgage and you pay 2 points, which is commonly lenders will promote like 2 buy down points or 2 points on their quotes to show a much lower rate. But that'll save you about 1% in mortgage rate to pay 2 points. So if you do that on a $500,000 property, that is $329 per month in savings. But on that $500,000 mortgage, not property, $500,000 mortgage, 2 points is 10 grand. So you take 10 grand divided by $329, which is the monthly savings. The break even on that is over 30 months. So you're paying more than 2.5 years of payments before you make that $10,000 back that you paid to get that lower rate. Now, right now, with the way the market conditions are, you're not going to be in this mortgage for 30 months. You're going to refinance again into the future at a lower rate. So buying down
and
really,
the crazy
truly
thing
doesn't
is
make sense.
that. I mean, it has been getting a little bit better with more, I guess, liquidity coming back into the market-ish.
Right.
But those buy down spreads, 6 months ago, 30-month break evens were nowhere to be found.
Yeah.
These were
like 4
years.
years.
5
4 or
plus
5 years.
years.
Yeah.
Which is even worse. And lenders would willingly advertise those and have clients close with those rates, even though they didn't need them to qualify, without giving them the details behind it. It's literally throwing money down the drain. So
the big advertised rates, the billboard rates you see here in Utah along I-15, those rates on the billboards, those rates are showing you rates with a 2 to 2.5% or 2 to 2.5 point buy down or cost in points on the mortgage. We are advocates of paying 0 points on mortgages. So oftentimes we're quoting rates that are higher than whatever's on those billboards. And we have, thankfully for our clients, we have a lot of in-depth consultations that dive into these details, and it does make sense in the end. So you got to be cautious on that, because at the surface, it's not all it's made out to be. And then one other detail that I wanted to just share here, and then you can close up with your final thoughts, is APR. So a lot of people are like, oh, I need to shop for the best APR. And APR is supposed to be a function of like the total deal. In other words, what's the rate and the fees baked into an annualized percentage rate on the mortgage, baking the fees in. It's not a good barometer. Yeah.
Spread.
Yeah, basically. It's like the fees added to the mortgage rate and then amortized over the term. But the reason this is a poor way to shop for a mortgage or any debt for that matter is exactly what we're talking about now. If I gave you, let's just say rates were at 6%, and I'm quoting you a 5.25% APR, and another lender's quoting you a 6.07% APR. If you're shopping by APR, in your mind, you might say, oh, of course, I want to go with the 5.25 APR. But what you're missing versus the 6.07, what you're missing is this underlying detail that I just mentioned, which is to go from to get a 5.25 APR, you're probably getting a rate of 5%, paying 2.5 points to buy that rate down to 5% from 6, 2 to 2.5 points, hiking your APR up to 5.25, whereas at 6 in this example, you're paying no points at 6, which is why your APR is 6.07.
So the spread between the note rate and the APR is much smaller. That's what you're saying.
That's what I'm saying. But what I'm saying is you can't shop based on APR because the APR, if you were shopping strictly on APR, 5.25, clearly you would choose that one all day versus 6.07.
For sure.
But if you understood the details that you're not going to make your money back for 30 or 36 months, you wouldn't choose that because the likelihood of a refinance is very, very high.
So APR is important, but it's relative to the note rate because the spread is where you find how much you're being charged to get that APR or the interest rate.
Yeah. So the best thing is I virtually, to all clients, I say just forget about APR. Look at what the lender fees are, what the fees that the lender are charging you. This would be points, origination, underwriting, processing, so on and so forth, and what the rate is. Compare those two and then run break-even calculations to figure out what the best option is based on the information you have at hand or whoever's guiding you, like us, we guide our clients a lot. Based on the information you know, what makes the most sense? Does the break-even make sense to pay the extra fees for the extra savings? And if not, you should probably pass and take the higher rate and pay.
Yeah. Well, and what we do oftentimes, and I guess we could use this to close up, during our consultations, I know people like options, and we like to give them to them. We obviously know which one would be the best in our expert opinion, which is generally your lower cost rate right now, while interest rates are still on their way down. But I mean, we generally give 3 different options. You've got your par rate, your no cost. You've got a 1-point buy down, and then we've got the 2-point buy down, which is generally what you're seeing advertised. And then what we'll do is we'll run those break evens on each of those rate options, and we just do the math with the client. And by the end of it, 9 times out of 10, they're like, okay, yeah, why would I buy down?
Yep.
So
unless there's
really
some weird reason. Like I had a client the other day, we had that conversation, and they said, well, I'm going to be quitting my job and starting my own business after we buy this house in the next year or so. And so we may not be able to refi for 3 or 4 years. In that case, okay, it makes sense. Buy down now, capitalize on the lower rate.
Or maybe people are converting to investment properties.
Yeah, you had a client that did that.
Had a client, and at that time it makes sense because if they go back to, interest rates could come down. If they try to refi as an investment, all that improvement likely is going to get eaten up by the hit in rate for it now being
the LLPAs, basically, now that it's an investment.
Yeah, so there are circumstances where it does make sense to buy down interest rate, but for the most part right now, it doesn't. And that's what we're advising. So,
and at different times it does. We've advised in the past very heavy buy downs to get lower rates, but I think the major takeaway, exactly, when they were low. And we are recommending in the future clients at some point, we're likely going to be recommending buying down. But you have to understand, I think the big takeaway here is you have to understand, one, what is the economic conditions, what is likely to happen into the future. You need to understand that. And then from there, you can make a decision. What are the fees I'm being charged? What is the rate I'm being charged? And what are the other options? And then just run simple break-evens. Don't make it as simple as like, oh, well, this rate is lower, or this APR is lower, or this billboard says that it's lower. All of that is really just BS. It's advertising, trying to set hooks so that you call because there's a low rate.
Yeah, and my favorite thing, too, is a lot of loan officers will play the 30-year interest accrued, which is insane because I don't know a single person who has gotten a mortgage loan and has paid every single payment for 30 years to pay that off. No one is ever paying that entire interest bill.
I've been in the business 16 years. I've refinanced every one of my clients, or they've sold and bought a new house.
Yeah,
probably 4 times. Every client I have.
Yeah,
and that's in 16 years.
Because even a 0.25% difference, if you run the life of the loan, the difference in interest paid, it's insane.
Hundreds of thousands sometimes.
So you look at that and be like, "Oh, why wouldn't I take the cost?" But you're not going to pay the mortgage for that long.
Yeah.
So, I mean, tangent there, but
that's a good one though. Yeah. Anyway, hopefully this is helpful. We know rates are mysterious. We know it's there's a lot of information. This is a saturated industry with lots of people advertising lots of things. But hopefully this is helpful to help you make better decisions. You can look up the LLPAs we were talking about. Just Google Fannie Mae LLPA, and you'll see a matrix. It'll show you exactly, like, based on this credit score, this down payment, and the page will talk about the occupancy. Here's how much you would get hit on the rate to create these points, and it'll help you make decisions as well. But we'd love to help. If there's anything we can do, hit us up.
Awesome.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.